Hi, my name is Andrew Rizet, and today my presentation will outline how payment systems operate in the banking sector. In every economy, a large number of transactions take place each day on the initiative of a wide range of economic actors. All transactions, whether they involve the acquisition of goods, financial assets, or services, have two settlement components. One is the delivery of the good or service, and the second is the transfer of funds using cash or deposits held with banks. A payment is therefore a transfer of funds which discharges an obligation on the part of a payer to a payee. Payment and banking generally go hand in hand, except for relatively small value transactions where cash, payment cards, and increasingly forms of e-money are used. Payments are usually made through the banking system. This does not mean that banks are essential to payments, just that in larger commercial transactions, the alternatives are generally inconvenient, insecure, or impractical. As a result, this presentation aims to examine the underlying payment systems that are in place for the banking sector and their relevant infrastructure. As defined by the Bank of England, payment systems are a set of common rules and procedures that support the transfer of funds between people, businesses, and financial institutions. Most payment systems are managed by operators, also known as payment service providers, and supported by one or more infrastructure providers of hardware, software, and communication networks. It is worth mentioning here that being a payment service provider is a regulated activity due to the systemic consequence a failure of one of the systems may have on the economy as a whole. As a result, many state or monetary unions have drafted legislation on that matter. For instance, the Payment Services Directive is a legal document that regulates the activities of payment service providers in the EU. It contains the prudential requirements for payment service providers to enter the market. Examples of payment service providers are plenty, such as PayPal or MasterCard, or even more popular nowadays, Apple Pay or Google Pay. There are two basic means of accessing a payment system. One is through direct participation as a full member, and the other is through indirect participation via direct participant. Simply put, direct participants can perform all activities allowed in the system without using an intermediary. In contrast, an indirect participant uses a direct participant as an intermediary in order to perform some of the activities allowed in the system, particularly settlement, doing so through the establishment of a bilateral agreement with the relevant direct participant. Correspondent banking arrangements is one form of these bilateral agreements. Correspondent banking is an essential component of the global payment system, especially for cross-border transactions. Through correspondent banking relationships, banks can access financial services in different jurisdictions. The main components of correspondent banking is that it is a bilateral agreement between two banks by which one of them provides services to the other, for example, the opening of accounts by a bank in the books of the correspondent for payment services such as settlement of transactions. There are three basic elements of making payment through the payment system that deserve to be highlighted. One is payment orders or messages. These are unconditional instructions to effect payment in favor of a payee. They may facilitate a credit or debit transfer. It is with the receipt of a payment order that banks effect payment. In practical terms, a payment order will divide between the customer's mandate to its bank to pay, the instruction which that bank then sends to another bank, and so on. Traditionally, payment orders were paper-based, but outside the realm of checks and payment cards, they are now conveyed electronically. Second is movement on accounts, which means that a payer's account is debited and the payee's credited. In addition, other accounts may be credited and debited, such as those which the payer's bank has with an intermediary bank or its correspondent. Payment through the banking system, whether by credit transfer, direct debit, check, mobile phone, or other means, involves a movement on accounts effected following receipt of a payment order. The third and most important element of the payment system is clearing and settlement. Simply put, clearing is the process of transmitting, reconciling, and in some cases confirming payment transactions prior to settlement. On the other hand, settlement is a transfer of value to discharge a payment obligation. In theory, legal tender may be used, but in a modern economy, movement on bank accounts are the most frequently accepted substitutes. Settlement can be gross or net, and conducted in real time or at designated times. In gross settlement, each payment instruction is passed on and settled individually across the accounts of the paying and receiving banks, resulting in a debit or credit entry for each and every payment instruction settled. In net settlement, gross obligations are discharged by the transfer of the net amount of value due from each obliger. In other words, payment obligations are offset against similar counter obligations. Real-time settlement occurs on a continuous basis during the operational day. On the other hand, designated time settlement occurs at pre-specified points in time, ranging from a single settlement cycle at the end of the day to frequent settlement cycles during the day. There are generally two principal settlement models, either the deferred net settlement or the real-time gross settlement model. The deferred net settlement model combines the net method with the settlement occurring on designated times, in other words, at the end of the clearing cycle. By contrast, the real gross settlement model, by its name, combines the gross method with settlement occurring almost at real time, in other words, almost instantaneously. Payments through the banking system can be categorized as follows. An in-house occurs when both payer and payee have accounts at the same bank. The payer's account is debited and the payee is credited. No other bank is involved. Where payer and payee have accounts at different branches for the same bank, an internal clearing system may be used. Domestic interbank payment means payment in the local currency between different banks in the same country. For the payer and payee, the settlement occurs simply by movement on accounts, in other words, through credit and debit. As for the banks themselves, settlement occurs by making payment across the books of the payment service provider, either immediately in the case of real-time gross settlement or periodically in the case of net settlement. Where a bank does not have an account with the payment service provider, it must settle through a bank that does. Traditionally, correspondent payment has occurred because of payment between persons in different jurisdictions. However, correspondent payment can involve payment between two banks in the same jurisdiction, especially if payment is to be in a foreign currency. In both cases, however, the banks use their correspondents in that other jurisdiction, since clearing and settlement facilities need to be available in that country. If both banks share the same correspondent, payment and settlement can be across its books. Otherwise, payment may involve using a local clearing system and movement on accounts which those correspondents have with the payment service provider of that jurisdiction. Finally, complex payments means where payment in a foreign currency may involve a string of banks. An intermediary bank may be needed where, for example, the payer's bank does not have a correspondent in the jurisdiction of the payment currency. Banks in 3 countries may be involved, as where the payer in London wants to make payment in US dollars to the payee in Singapore. One way of doing this is for the payer's bank to send a payment message to its correspondent in New York, which in turn contacts the payee's bank correspondent there. Ultimately, the payee's account with its bank in Singapore is credited. At the heart of each jurisdiction's payment system is a large value payment system for the relevant currency. For example, CHIPS and Fedwire in the US for dollars, Target 2 in the EU for euros, and CHAPS in the UK for pounds, and so on. If, say, a German bank wants to pay in US dollars to a Chinese company, it will probably instruct its New York correspondent to pay the Chinese company's bank through the latter's also New York correspondent. In this case, the transfer between the two New York correspondents will be effected through New York's large value payment system, namely CHIPS. Similarly, if the German bank wants to pay in pounds, the CHAPS system will be used. Thus, while they are based in particular jurisdictions, these large value payment systems have international implications. It is for this international character that these large value payment systems have been heavily discussed, since the failure of one system may trigger a domino effect on the whole global economy. This is why most large value payment systems settle across the books of the central bank and hence use central bank book money, which is considered a risk-free asset. To conclude, payment systems are the instruments, procedures, and institutions that enable persons to effect payment. The complexity and in particular importance of market infrastructure for the handling of payments has increased greatly in recent decades. owing not only to the tremendous increases observed in the volume and value of financial transactions, but also to the wealth of financial innovation and the advances seen in information and communication technologies. However, it is important to finally note that public trust in payment systems is vital if they are to effectively support transactions. It is the legislative and regulatory framework that underlie these systems that actually provide the public with that trust.